ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, friend. I've got a question.
Your question answered.
Now, the question today comes from Ben. He has recorded it as a voice message. If you want to ask your question, would love it if you could record it as well. If you go to our website, equitymates.com/contact, there's an option to record it there.
Hi, Equity Mates. My name's Ben. I'm a big fan of the show and would love to hear your thoughts on my current predicament. My partner and I, similar to yourselves, became first home owners last year. Currently, we have a $700,000 mortgage at 6.2%, and I'm faced with a dilemma. I can place all of my funds into the offset account to reduce the interest on our mortgage for technically a guaranteed ROI of 6.2%. Alternatively, I can invest those funds into something safe like an index fund in hopes of achieving a higher return. I'd also like to contribute more to my super, especially after listening to your recent podcasts, but I'm conscious that every dollar taken out of my offset account results in more interest being applied to our mortgage. So I'm wondering, is this something you've had to consider, and how have you guys navigated this dilemma? Thanks for your insights.
So Ben, thank you for your question, and it is certainly something that we have considered, and it's something that everyone considers in their own way. You know, for people that have a mortgage, you know, I guess they have three options broadly. They can invest it inside of super, they can invest it outside of super, or they can put it in their offset. But also, you know, for people that don't have a mortgage, you still have the choice of investing inside of super or outside of super. And I think the place that we want to start is two just general points. First of all, everyone's goals and circumstances are different. And so we'll talk generally, we'll talk about how we think about it, but you've really got to think about what you want out of your life and your money, because it is personal. So that's important to stress. The second thing to stress, whatever choice you make is a good choice. Investing inside of super, investing outside of super, putting it into your offset, you're taking steps to build your wealth and to set yourself up for the future. And so whichever one you decide, like, just be confident that you're taking positive steps. Because a lot of people get torn up about, am I making the right choice? But just know that by doing any of those things, you're doing well. With that said, Bryce, let's get into the choice.
Nice. I thought it's probably a good point to start by explaining the power of an offset account to those that don't have one, thinking about getting a mortgage, because they're pretty powerful. So the idea of an offset account is that the cash sitting in your offset account is reducing the interest that you pay on your home loan to the value of 1-to-1. Meaning, if you have $800,000 as a loan and you have $100,000 in your offset account, you're actually paying interest on $700,000.
Yeah. Now, I think the really important thing to stress is, like, your monthly repayments don't change. It's just the percentage of that repayment that goes to paying interest and the percentage of that payment that goes to paying principal, like paying your loan down, changes.
Yes.
Now, there's an example that you used on our Instagram. And so if people aren't following us on Instagram, you're missing some great videos of Bryce walking and talking finance. You used an example of a $500,000 loan and $20,000 sitting in the offset. So not a crazy amount of money sitting in the offset relative to the size of the loan. Just having that $20,000 sitting in your offset over the life of the loan will save you $90,330, and it will pay off your loan 2.5 years faster. Now, that's assuming that you've got a 6.25% mortgage rate, which is kind of what we're seeing in the market these days. So just that $20,000 sitting in your offset saves more than 4 times that over the life of the loan from reducing your interest payments. So they're powerful.
Very powerful, yeah. The other thing that Ben noted was that it is a guaranteed return. And what we mean by that is, because you're paying less interest on your loan, you're technically saving money, but that money that you're saving is after tax. So you're not paying tax on that. And so you are guaranteed that savings or that return.
Yeah, so like the equivalent, you know, it's not like if I got 6.2% in the share market, it's the same. Based on your marginal tax rate, you probably you need like almost 10% return in the share market to get the equivalent of that 6.2% saving from your offset.
Yes. So while you get the guaranteed return, the second part of the equation is the stock market equation. Should I chase higher returns? So just a gentle reminder that the long-term returns of the stock market here in Australia, ASX 200, 13.2% since 1900.
Yeah, 1900 to 2022. That's 122 years of stock market history, 13.2%.
Yes.
Including dividends.
Including dividends. So it's a very powerful way to build wealth over the long term. So what Ren said earlier, either or are great alternatives.
Yes.
You're doing the right thing if you're doing either or. But how do you balance it? Well, mathematically, if you're comparing the two, there is a mathematical answer to it. If you want to put your money outside of your offset account, as you said, Ren, you need to expect to generate returns closer or above 10% because you need to consider the tax that you're going to pay on that. So you can do the maths on that. However, I think most importantly, it really depends on your overall wealth goals. And this is where we can talk personally to our experience. Because if you're piling all of your money into your offset account to pay down your home faster, you don't like having debt, you just want to get that done. That is all well and good. You might find you get to a point in your life, though, where you are debt-free, but you have no other assets outside your superannuation and your house, which might be what you want. But if you then want a portfolio of stocks that are going to create income for you or that you can use later on in life, you're going to have to play catch up on doing that. And that's the way that I think about this.
Yep.
What about you? How do you think about it?
Exactly the same. You can't. I was about to say you can't eat a house, but that's probably not like the clearest analogy. But the flexibility that I want later in life won't come from having a fully paid off primary residence and a growing super balance. Because when I'm 45 and I'm sick of podcasting and I want to take 6 months off, I can't draw on either of those assets. Asset rich, cash poor, not liquid, all of those things. But ultimately how I think about it is like the taco ad, why can't you have both? Yeah. And so to
Not
speak
mutually exclusive.
To speak personally about how Alice and I are managing our offset, so we have automatic transfers set up to our offset. And, we split the mortgage equally and we each contribute more than our share each fortnight when we get paid, if that makes sense. And so it's like we're slowly building up the offset every fortnight, every time we're transferring money into it. But then at the same time, I also have an automatic transfer set up to my stock brokerage and I'm dollar cost averaging into a portfolio of ETFs at the same time as well. And then I also have a little going to an account where I can buy stocks as well. But that's a smaller percentage compared to those other two.
Nice.
Much smaller percentage than compared to the mortgage offset.
Yeah.
But for me, at this stage, I'm not contributing any more to super because I'm like, after doing that, I'm stretched. And for me is what I more want to do, build the offset up and have a portfolio of stocks outside of super to give myself that choice. I think you can strive towards both goals.
Definitely.
It's just like both goals are going to take longer to achieve. But that's how I'm approaching it.
Yeah, I agree. Not mutually exclusive. And should you get bonuses or, come into tax returns, those sorts of things, offset's a great way to sit cash while you think about what else you might want to do with it as well. Like anything that goes into there. At the moment, we find between Harriet and myself, if we get to a sort of certain level in our savings account, we just flick it across to the offset because it's like we don't need this money right now. It's being saved. Sit it in the offset. And we actually find psychologically that it probably stays in there longer than if it were to sit in one of our other savings accounts.
Why do you have a savings account?
Things like travel, for example, saving for Bali. Last 12 months, it would be sitting in a savings account, but now we're like, because psychologically we don't want to draw out of our offset account.
Yeah.
We just want that to sit there and be distinct.
So we're quite limited in the banks that would lend to us.
Unfortunately, ANZ, who we're with, doesn't have multiple offsets.
Yeah, I was about to ask that question. Multiple offsets.
Yeah, I looked into it.
Yeah, okay.
Frustrating.
Yeah.
Yeah, so I've probably...
Well, let's put the call out to ANZ. I'm not sure how much we could change, but how hard is it to allow multiple offsets?
Good question. ANZ, hit us up. We want to know. But anyway, this is a question we get asked a lot. As Ren said, check out our Instagram. We do a bit of content on there. We also have an Ask an Advisor with Dylan that has been released where we cover this question as well. If you would like professional advice, though, head to equitymates.com/advice, fill in the form, and we'll connect you with one of our advisors who will be able to help you work through this, because there are individual ways in which you can really maximize this. But it's just based on
Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity